Hey there, future CFAs. Today, we're diving into the fascinating world of corporate issuers. Corporations are the most common type of issuer in financial markets worldwide, and understanding their structures and features is crucial for any finance professional. We'll cover different types of businesses, their characteristics, and the distinctions between privately held and publicly traded companies. Ready to get started? Let's dive in. Organizational forms of businesses. First off, let's talk about the organizational forms of businesses. The four most common business structures are sole proprietorships, general partnerships, limited partnerships, and corporations, limited companies. This module focuses on the differences between these business structures in areas such as legal relationship, owner-operator relationship, business liability, taxation, and access to financing, with an emphasis on corporations. We'll focus on corporations, but let's quickly go through each one. A sole proprietorship is owned by one person who funds and controls everything. It's super flexible, but comes with a big downside. The owner assumes all risks and profits are taxed as personal income. For example, think of a family-owned store. It's simple, but growth is limited by the owner's resources and risk appetite. Next, we have partnerships where owners share resources, risks, and returns. There are three main forms. General partnership. Two or more individuals, general partners, join forces. They share profits, losses, and have unlimited liability. This setup combines skills and capital, but comes with the risk of covering each other's financial obligations. Think professional services like law firms. Limited partnership, LP. This structure includes general partners with unlimited liability and limited partners with liability capped at their investment. LPs don't manage daily operations but enjoy pass-through taxation. It's a mix of investment with limited risk. Limited liability partnership, LLP. In LLPs, all partners have limited liability. It's common in professional fields like accounting and law, where regulations can restrict partner numbers and investments. Now, on to corporations, the primary focus of this lecture. Corporations are legal entities separate from their owners, offering limited liability, access to significant capital, and a structured management system. There are two main types: private limited companies. These offer limited liability and ownership divided into shares, but have restrictions on the number of owners and share transfers. They're known by various names globally, like LLCs or S corporations. Public limited companies. These have no limits on ownership or share transfers and are ideal for companies going public. They face double taxation, but benefit from reinvestment opportunities. Public companies can raise large amounts of capital and are common among multinationals. Key features of corporate issuers. Let's break down the key features of corporate issuers. Legal identity. Corporations are separate legal entities, allowing them to make investments, sue, and pay taxes independently of their owners. Owner-manager separation. Management runs daily operations, while owners, shareholders, have limited involvement, primarily through the board of directors. This separation helps in effective resourcing and risk management. Owner-shareholder liability. Shareholders have limited liability, meaning their risk is limited to their investment in the company. They share in the company's returns through equity claims after liabilities are paid. External financing. Corporations have unlimited access to capital through equity and debt. They can raise funds from a diverse group of investors, including individuals, institutions, and governments. Taxation. Corporations face double taxation. Profits are taxed at the corporate level, and distributions, dividends, are taxed as personal income. Despite this, they can store profits within the business in jurisdictions with lower corporate tax rates. Publicly listed companies have shares traded on stock exchanges, providing liquidity and price transparency. They can issue new shares and must comply with registration and disclosure standards. Private company shares lack price transparency and are not easily traded with investors motivated by higher potential returns. Public companies can raise large amounts of capital from many investors, while private companies finance smaller amounts from fewer investors who hold for longer periods. Public companies are subject to greater compliance, disclosures, and regulatory requirements aiding risk assessment. Private companies face fewer regulations and disclose less information. Private businesses can go public through initial public offerings, IPOs, direct listings, or acquisitions, including those by special purpose acquisition companies. IPO is underwritten by investment banks, allowing the company to raise capital. Direct listing, where existing shareholders sell shares directly on an exchange without raising new capital. Acquisition, by a public company or a special purpose acquisition company. Conversely, public companies can be taken private by investors who acquire all shares and delist the company, believing they can increase its value and operate with more flexibility. The number of public companies is increasing in emerging economies and decreasing in developed economies due to mergers and acquisitions. Corporations can have diverse shareholders, including institutional investors, individual investors, other corporations, governments, and nonprofit organizations. Governments may establish legally autonomous corporations while maintaining ownership to enhance transparency and accountability. Nonprofits may hold substantial shares, balancing financial goals with social responsibilities. Understanding these concepts is essential for any CFA candidate. Make sure to practice with examples and end-of-chapter questions from the CFA curriculum and the FinQuiz question bank. This knowledge will not only help you ace the exam, but also provide a solid foundation for your future career in finance. Keep studying, stay curious, and you'll do great.